Hello viewers, now if you add Options and Renko together you get something very special, something very powerful. And what can you actually do with that combination, especially if you had a small account, say even just $1,000? You'd feel quite restricted if you didn't know, how the options world work and how Renko work. But I've got a great strategy for those with a very small account. You can still trade the options, you can still make a decent return from them, and in this video I explain what that strategy is and how you can combine that with Renko to come up with something really great. So let's get into it. Right, let's start with options part first. Now, back in the day, I used to be a professional options trader on the desk for a big US trading company. Did it for quite a few years. I was a market maker, trader, strategist in the options world there in commodity space. That's where I learned the nuts and bolts all about options trading. I found it a fascinating world because what I really love about option trading is it can give you, you can set out to create a very defined risk reward payoff strategy structure for any trade that you do, and that is brilliant if you've got a small account. Now when I talk about small account, I would say $3,000 to $5,000, but in this case we're looking at the micro account around about $1,000. If I had $3,000 to $5,000, I'd probably be looking more into credit spreads and some other strategies, but at $1,000 really, there's only one that works for me consistently, and that's called debit spreads. And that is what we're going to look into in this video. But please do learn about how options work first. Don't just jump in. Lots of content on this channel for you to check out in that space, and a lot more coming for that matter as well. And then with this strategy, you've got $1,000, you might only want to risk $50 per trade. We can do that and still get that decent return. I'm going to show you how to do that, but added on to that, moving into the Renko space, that's going to be our trading filter for this setup. That adds a whole new weight, power to the whole setup strategy, and then combined with a proper set out, laid out sort of trading plan, you can turn this into a nice, like I say, money making income, grow it up, get into the next level of small account. Then you can start adding other options strategies, like I said, credit spreads, whatever. We'll cover them off another time, but like I said, you can build that up and then become much more independent as a trader. And I think what we're going to see here is going to get you off on the right track in the Options Renko trading world. So I'm going to focus on US stocks for this strategy. They're available globally, easily accessed, brokers all around the world, and I'm going to put that together, like I said, in here, and we're going to get into all that right now. So what is a debit spread option strategy? Well, it's a combination of two options together to give you a point of view on a directional base on where you think your stock might be going. So if you're bullish, you put a combination together, and if you're bearish, you put a combination together. Whereas if you just bought an ordinary call or ordinary put, you've got the full access to the upside and the downside. Here we are capping quite deliberately the upside, and that reduces down our costs and makes it much more affordable for the small account. So that's essentially what a debit spread is. But that sounds all great, but what's the detail, the nitty-gritty behind it? Let's just take a look right now. Like I said, there's two strategy setups here, the bull call debit spread and the bear put debit spread. We're going to look at both of those. Like I said, perfect for small accounts, very structured, very defined. But let's jump into the bull call debit spreads. What is it? It's a directional bullish option strategy built by using two call options. So you buy the call, the lower strike, and you sell the call, the higher strike, one of each, and both with the same expiries. But what does that look like? Well, I like using payoff diagrams to illustrate this. I think it makes it a lot more straightforward. So let's have a look at that. So it's just the addition of two options positions, the long call and the short call, and you can see them on the left hand side, and added together they give you that payoff profile. Now the important thing to note from this payoff profile, note the downside is capped, where that goes horizontal at the bottom there on the left of that chart, but also notice the top side is also capped. We can't make any more profit than what it was in that nice 45-degree range there. So the downside is, the upside is capped, but we are in a much cheaper, safer play, so to speak, for that directional point of view. And here with the bull call debit spread, you can see that it's bullish. You want the price to be going up, so your point of view at the time of putting this on is bullish. So let's put that into a bit of context, the bull call debit spread. So why would we trade it? Well, when our Renko setup confirms a bullish reversal continuation, and we're looking really for just moderate upward movement, not too dramatic, not too explosive, and it's brilliant for trading small trends over 5 to 10 days and works very well when implied volatility is low to moderate. And how could we build this? Well, we would buy the at the money or slightly in the money call and sell the out of money call one strike higher. So I'm going to show you exactly how that works shortly, and what that means for the strikes. And we're going to use we're going to pick a 1 to 2 week expiry. We're going to get in on the Monday, and we're going to exit by the next or following Friday. So an example there, you could buy a 180 call and sell a 185 call with 7 days to expiry. So what about the profits and risk of the trade? Well, the max profit, as you've seen, is limited to the spread width minus the debit paid. The max loss is the debit, i.e. the cost to enter the spread, and the break even is the lower strike plus the debit paid. So typically risk 100 to 150 to make 150 to 350. That's the risk return we're looking at. You pay a debit up front, so that's where it gets its name from. That's your maximum risk, and you're a net buyer of options, so it costs money to open, i.e. the name debit. So what are the risks to this trade? Well, it's limited upside if the stock surges beyond the upper strike, so you sort of miss out on a lot bigger gains. Time decay, that's called theta in Greek terms, hurts if the move happens too slowly. IV, crush post earnings or big events can reduce spread value, hence why we try and stay away from the earnings world. And directional risk, if the price reverses quickly, you're going to lose your debit, but at least we know that it's capped and we know the max amount we can lose. So let's summarize the advantages for the small account. We know our defined risk, so you can't lose more than you pay. It's cheap to enter. It says there, trades typically cost 100 to 150, but depending on your filter and the stocks you're looking for, you can get it down to $50, $75 and still, make it work. Easy to manage, clear exit points, simple rules to follow once you get the trade on. And it's a smooth P&L curve, no sudden spikes in risk. Now the flip side of our bull call debit spread is the bear put debit spread, where we want the market to be going down. So it's directionally bearish and built using put options, not call options. We buy one put, the higher strike, and we sell one put, lower strike, again the same expiry. And as you can see there from the chart, this is what are the component parts to make up the payoff profile. And you can see over there on the right, bottom right there, that the profit and loss payouts, you can see that we need the market to be moving down. It's capped to our upside as that price falls, so it's limited there, but also limited risk if things go wrong, again making it a great trade for a small account. So why you trade it exactly the same really as the bull call debit spread, but other than that, it's the other way around. We're looking for markets to move down, over 5 to 10 days in downtrending risk off conditions. And how we put that together, build it. We buy the at the money or slightly in the money put, we sell the out the money put, one strike lower. and it's that 7 to 10 day expiry period, getting in on the Monday, getting out by the Friday of the next week. So in terms of profit and risk on this trade, the max profit is the spread width minus the debit paid. The max loss, and that's the total risk, is that debit paid. And break even is the high strike minus the debit paid. And the risks of the strategy overall, limited downside profit, only up to the width of the spread. Volatility crush if market stabilizer bounces. Time decay theta erodes value if price doesn't fall quickly enough, and directional risk if market reverses upward suddenly. So exactly the same as the bull debit spread, but just the opposite way round. Now I've put together this comparison table of the two strategies, and you can see the different features there, from the market view to the structure to the cost to the risks, all down there, why it's ideal for trading, the risk reward ratios and what it's suited to. So hopefully you can stop and play that back if you need to remind yourself of how it all works. So key takeaways: debit is you pay to enter, unlike credit spreads where you're paid. We've got a defined risk, cap reward, perfect for small accounts, easy to align with Renko direction. Designed to be traded as a weekly system. You enter Monday, you exit by the next Friday, and then you reassess. All quite straightforward. So we've got the understanding now of the options strategy that we will be using. We now need to see it really in its practical form, from taking it through, from filtering from the stocks that we're going to use, the Renko setup, and then putting on the options trade. Now the actual chart setup is very simple here in the Renko world. You can do it very easily in something like TradingView. The example here, let's have a dive around the setup here. On the right hand side you can see you've created your own watch list of stocks from the filters, which we will look at how we get that list together anyway. But the important things here are rule set for the Renko setup. Now, first of all, block size. Do not worry about that. I'm going to tell you how to set it, and it is a bit different to the normal approach for this because we're thinking in options this time. Now, down to the bottom, we got the RSI, and what we're just looking for is if it's above, it's our bullish debit spread. If it's below, it's our bearish debit spread. And when I say below and above, it's above that 50 line that you can see there, above or below that. Then we've got the stochastic above that, set to I believe it is 5320, and what we're looking for again is momentum coming up through the bottom band for bullish and down bearish, confirmed with that moving average percentage D crossing over as well. And then we've just got a 10 and a 50 moving average, and if, for example, all lined up, and this is Nvidia here, we would be looking to go long there with our call debit spread. So we got the RSI above 50, the stochastics all lined up above the moving averages. Thank you very much. That is our setup, and it works the same across all the stocks that we will look at. The important thing though, like I said, is the block size and how you set that, because we're talking about a time horizon of possibly 5 to 10 days, so we need to filter out a lot of the noise and get the momentum and the trend trajectory correct for being able to put on these trades. So let's get more into the rules. So we've got to think more like options traders for this strategy. We're using Renko to help filter out and time our trades in. But what about the block size? Well, I've created a separate section of this because it's the most important, or one of the most important elements of the whole setup, because we want to get rid of the noise of the daily, burble that's going on. We want a 5 to 10 day horizon in the trend and momentum. So how do we do this? Well, we don't use the traditional block size calculator approach that we know about. We use what I I've learned from trading options in the past is the at the money straddle for our time horizon, because that's giving us the expected move for the week or 2 weeks ahead from the options market, and they normally know what they're doing. So that's where we're starting. Now in the example here we've got Nvidia, and I've just plugged in a straddle for 4 days ahead. It's Monday and we're looking to our expiry on the Friday, November the 7th. You can actually see that gives us a combined price of just over $10 for the trade there, the straddle. So that means that if you took the current stock price of Nvidia, which is about $202.50, and divided it by the premium there for the trade. So we do $10 divided by the price, which we just said was, you know, around $202.50. That equals a potential move of about 5% for the week, 0.049%. So Nvidia is expected to move plus minus 5%, but we take that premium $10 and we divide it by 3 to give us our block size. So we're looking at 3.33 as the block size, but we would round that up to 3.5. If you want to be more aggressive, take it down to 3. But that is how we calculate the block size. We're taking a fraction of the expected options market move for the stock that we are looking at. So let's just summarize that so we can see the rules more clearly. Right, so summarize the block size method. The goal is to calibrate Renko bricks to the market's expected 1 week move. So signals align with a 5 to 10 day debit spread trade. So the inputs, current price, the spot. This Friday's at the money call premium and at the money put premium. Same strike. Spot, corporate events earnings. There's a caveat in there. Watch out for that. We want to avoid earnings if, you know, within 10 days, because that produces, you know, a lot of volatility, which makes our returns a bit more risky, and we want to take the risk out of it. And there's the formula, the core rule: get the at the money straddle, divide by 3, round to, you know, from our Nvidia example to the nearest 50 cents, depends on the price, but just round it up or down. It makes it easy to use on the Renko charts. And an example there, the Nvidia, there's the stock price. The at the money straddle was $10. We've got our 3.33 block size, so we could either go 3, 3.5, depending on our risk appetite. And let's just have a quick look at that again on the chart. Now you can see I've plugged in up the top there the Renko block size of 3.5. You know, you could change it, like I said, down to the 3. Makes it a bit more granular. In this instance, doesn't change it too much. It would still be a nice a long trade there using our cool debit spread setup. Now we need to find our stocks, and how we're going to do that? Well, we are going to lay down a criteria and get a short list together. Now there's plenty of free tools out there that you'll be able to do this through, but I'm running this quick stop filter here. $10 to $80 is the sweet, well, say 20 to 60, but 10 to 80 is our stop price range. Why? Because if we go bigger, the spreads become more expensive, and we need to manage our risk. We're only going to be risking between, say, $50 to $75 on any trade on our very small $1,000 account. We want average daily volume of shares greater than 2 million. Options volume, we need some of that as well, definitely do. And open interest along with that, those sort of numbers that we are requiring. If you can, try and keep the bid-ask spread on the option as low as possible. We need to be, you know, looking at efficiency in this strategy too. And another good one to use is the implied volatility rank between 20 and 60. That gives us reasonable premium and avoids overpriced options. Obviously, we got our Renko set up. Earnings date, we don't want anything within 10 days. And industry bias, find the sectors that are hot at the moment, obvious ones, tech, AI, those sort of things. Sectors that are of interest. That's going to create the flow and the options volume that we are looking for. So what you do is you'd put that into a filter, run it, and you'd come up with your short list of stocks to trade for the week ahead. So we're starting to put together our strategy now, but we've got to start with risk and position sizing parameters. We are assuming we're starting with $1,000. That's our small account pot. But also remember, you can do this strategy on far bigger accounts. It's just, really well suited for this size of account. And we're going to risk 5% to 7.5% per trade. So that gives us a max defined risk of $50 to $75 a trade. We're not using a fixed dollar amount because we want to compound. Notice that last point there, up our trades as the pot grows. So we're taking on bigger positional size in terms of dollars, but not in terms of risk. And we're going to be doing 3 to 5 trades on the Monday. So that's giving our max exposure of about 25 to 35% at any one point. And remember that compounding rule as well. Right, so Monday, we want to put some trades on. What do we have to do? Well, we've got a bit of preparation before that. Sunday / pre-market Monday, we've got to finalize the block sizes, get the straddle information out, get set for the week ahead. Now, Monday pre-market, also check the overnight futures, news for sentiment bias, confirm that there's no earnings or major date releases ahead. We don't want them to mess up our trades. And you're going to say, well, what are the best entry times for this strategy? Well, I'll pick 2 for you here. 9:45 to 10:30 a.m. That's Eastern time there. That's the primary entry window. Why? Because early volatility has stabilized after that first 15 minutes. Spreads will start to tighten and the Renko indicators will confirm that first part of the movement of the day. Or there's the 3 to 3:45 p.m. Eastern time, secondary confirmation window. Again, option spreads tighten against the close. Good fills if morning conditions unclear. I prefer the 9:45 to 10:30, but please experiment yourself. And something to avoid: lunchtimes, 11:30 to 1:30 Eastern time. You'll see options spread widening. They become more expensive and it will erode our possible gains. So let's summarize that Monday execution process very quickly again. So we've done our review, Renko indicators, everything's lining up. We choose 3 to 5 different tickers from our filters that meet our requirements. We structure the debit spreads. We buy at and near at the money. We sell one strike out money. We're risking $50 to $75 each to start with our £1,000 pot, and we're going to journal, the entry details and keep on top of what we're doing right from the word go. So Wednesday I like to call management day. If you're into golf, you might call it moving day. By the middle of the week, what you often see happen is a lot of our objectives may have been met already, and we want to maybe manage our way out of these trades already on the Wednesday to lock in the profits and make our rest of the week pretty much easier. So what we do is on the times that you can see there, we check our positions, and if they've reached 60% of our profit target, because remember these are capped upside trades as well, we can take off maybe half of the trade. We could take off 75%, all of it, or if it's already met our target, we take off all of it. It's no point holding on to it. So Wednesday's like our review day, and there's a second window slot there to review as well, 3 to 3:30 as well. Also saying, if you're losing as well, or flat trades, looking like they're turning the other way, get out of them. Save yourself, not getting hit to your full maximum, defined loss there. So the rules I've put there, in summary: opposite Renko signal or stochastic cross, get out, because remember we have set that to longer term. If trade is up 60%, take off half. Or if you can't take off half, maybe all of it if it's meeting the criteria. If spread less than equal 50% or time decay accelerating, cut the position, or never add to losing positions mid-week. Now I've given you an option here around your own risk perspective on what you want to achieve from this. There is the option of the Wednesday reload, and I've called it that because basically after you've done your Wednesday tidy up and you are maybe closing all your positions out, or you've taken some off, you've taken off some losers, you might want to put some new positions back in. Now you're going to have different choice of expiry dates here. You've got the immediate ones for the week, we're on a Wednesday already, so you only got 2 to 3 days of expiry left, or you've got the following week, which is 7 to 9 days of expiry, or you can just skip and wait till Monday. So you can see each one of them comes with their own risks. The 2 to 3 day, you could maybe start erring into the world of zero DTE gambling type stuff. 7 to 9 days, then that overrides our Monday filter. So you've got to be sure that the cost of holding them through till the following Friday or Wednesday, for that matter, for the review day is worth it. Or you just stick to the plan and you skip and hold whatever you've got left to the Friday and then start again on the Monday. But you've got to reassess the block sizes as of the shorter expiry if you are going to put trades on. It's same positional and structure and risk rules, but I've also highlighted when really not to reload whatsoever. If you know there's a major risk event ahead, where it, for example, says there, the IV is greater than 60 with wide option spreads, the RSI looks overextended, the remaining brick move in your target, because remember you've worked out the money, the expected return. If the move isn't that significant left in it, don't bother taking on the risk. So only use same week expiry if the move is active, cheap, and has greater than 2 bricks left with tight spreads, size at the low end. Keep the Monday, Wednesday, Friday time windows and exposure cap intact so you never drift into that, like I said, zero DTE type gambling of options trading. So then on to the Friday, and the goal is to get flat by the end of the week to reset for our Monday morning churn. Check times 10 to 10:30 Eastern time. Get rid of the strong winners. 3 to 3:45 the final exit window. Now I've also put in there, try not to hold debit spreads over the weekend. The theta, time decay, crush plus gap risk can erode small account gains. Now if you go back to the previous thing we were looking at, maybe the Wednesday reload, where we could maybe add for a 7 to 10 day future expiry of an options set up there. Remember that's going to be held over the weekend, so that's going to be more suitable for the slightly bigger accounts, or the more certainty you have of that trade winning. So really, if you do go back to the previous slide, Wednesday is really just a management day to lock in profits. Friday's the final tidy out before we start again on the Monday. So here's our checklist for the week. Friday, or like we said, Sunday evening, Monday pre-market, build the watch list, set the brick sizes, do your homework, get 5 to 10 tickers out there, maybe even up to 20 for possible trades. Then Monday we're going to enter 3 to 5 of the best trades there. We're going to have that fixed risk size, 5 to 7.5% of our account, maximum exposure about 35%. Wednesday is like review day. We're going to trim exit winners, remove the losers, lock in the profits, and then Friday it's get out of everything. And then Monday it all starts again. We rinse and repeat, but remember that compounding rule. We're getting more risk. So that 50 to 75 that we started on our $1,000 account grows as we become more successful, but we're not taking on any more risk. That's how we can build up our small account fund a lot quicker, a lot more safely, and get it to something more meaningful. So there you go, the Renko Debit spread option strategy. Whether you're bullish or bearish, there's an opportunity there for you. Now know how the option strategy works. You've seen how you can piece it together using Renko, options information, stock filters, all put together to create a real strong strategy process. And we've also seen how we can execute it and follow the rules from Monday to Friday to grow our small account. And we were talking accounts less than $1,000 here. I think this strategy is really good for that, but I do suggest you go and learn about options trading as well. Plenty of content on my channel here for you to follow up on, but once you get the hang of it, this really is an effective strategy. And it brings me nicely on to how you could deploy this into 2026. We've got our Renko Masterclass coming up in January. We've got some fabulous offers on at the moment. Early bird, where you can also get hold of a PDF copy of any of my books there behind me. Links in the description below for you to get on board there. Nice to have you there. But like I said, this forms part of that process, how to build that small account into something meaningful so we can turn it into like a strategic business approach, grow your funds and give you the opportunity to grow as a trader. That is there waiting for you to join in on. So I'd love to see you on that. And if you like today's video, please give us a thumbs up. Don't forget to hit the notification buttons for future content coming your way. Once again, thank you for joining me. I'm glad to have you on board the channel. Your support always helps. So, hope to see you in the next video.